Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Null. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Null here, alongside co-host Michelle Lee Melton-Null. The double dip ice cream to my sugar cone.
Double dip, eh?
That's right.
All right.
How you doing?
I'm doing well, I think.
Yeah.
Happy New Year, everybody.
Happy
I haven't
New Year.
been here.
You're back.
Well, we'll see.
Yeah, you're back. All right. Well, we are, speaking of being back, we're in Coastal College's recording studio, beautiful downtown Fairhope, ready to put together another great show for those of you tuning in. Listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store for you. First segment, deep dive on our topic of the day. Second segment, about 30 minutes past the hour, that's headlines of the week. And then roughly 50-ish minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. Buckle up, we've got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Null. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. And if you just missed that contact info, grab a pen, grab a pad. We're going to repeat it several times throughout the show. All right, Michelle, for today's episodes, we're going to attempt to answer the question, should investors hold individual stocks in their retirement accounts?
I'm going to go with yes, for selfish reasons, because I do.
Yes. Okay. So, but at first blush, it's going to seem like a no-brainer, like you just said. But what many investors may not realize is that the majority, if not all, of their investment accounts are held in groups of stock investment vehicles, such as mutual funds and exchange-traded funds, or ETFs for short. So especially many of you that have your retirement assets held in a qualified plan, like a 401k or a 403b, there's a pretty good chance that you are mostly, if not entirely, invested in what's called target date mutual funds. And there's even a better chance that you may not even have the option to hold individual stocks in your plan. So we're going to be talking kind of more specifically around individual retirement accounts and IRAs and after-tax, what most people call brokerage accounts, or what in our world it's really an after-tax advisory account. But what we're going to do is, Michelle said yes, but we're going to qualify all that. We're going to talk about the benefits and the risks of allocating some or a significant portion of your portfolio to individual stocks versus having everything in a basket of stocks, such as a mutual fund or an ETF. That makes sense?
I think so, yeah.
Okay. Well, let's start with some basic definitions, if you will.
All right.
All right. I'm going to ask you first, and then we'll give the Gemini AI generated definition.
Ooh.
See how you match up with Gemini here. Michelle, how would you describe an individual stock?
Okay. Well, I have 7 or 9 in my Charles Schwab account.
Okay.
So.
Do you remember any of them?
Yeah, Coca-Cola.
There you go. Now, all right, let's start there. So first, what is an individual stock?
I mean, I have stock. I paid for my share.
Okay.
I have one share.
All right, so
one measly share in Coca-Cola.
Now, why do you have that one share in Coca-Cola?
Because it's expensive. And I asked my parents for Coca-Cola shares all my life, and I never got one. So when I could finally afford some, I did.
And you like having Coca-Cola.
I like Coca-Colas.
There you go.
But I limit them because they're not so good for you.
Well, the technical definition of an individual stock is a single share representing
See?
Yes. Well, single share meaning you buy one share at a time. You just happen to hold one share of Coca-Cola. You could buy more if you wanted to.
Correct.
Right. It represents partial ownership in one specific company, granting the holder a claim on that company's assets and earnings. It's traded on exchanges, and it differs from mutual funds and ETFs. It lacks built-in diversification because it's in one company, thus, generally speaking, carrying higher risk, but also, generally speaking, higher potential reward and control. Right?
See, there you go.
Yeah, if you want to own a piece of Coca-Cola, you buy a Coca-Cola stock. If you want to loan money to Coca-Cola, you buy a Coca-Cola bond. All right? What's your definition of a mutual fund?
I mean, a mutual fund, I think, is a bundle of things, right? But is it a specific flavor?
It can be.
Like, do you do energy sources in a mutual
You
fund?
can, yes. That's good. Very good.
Okay.
Yeah.
I mean, I think I've seen that somewhere. I don't know if I have something like that, but I might because I have others. I've got those things that you look at for Empowered. I think that might be some of them.
Yes. Yeah. So as you said, mutual funds can have a variety of investment strategies.
Do they have to be correlated, though, and have the same theme?
Well,
or can they just be total rando?
There's the prospectus of a mutual fund lays out the goals of a particular fund.
Okay.
And it basically binds the fund manager to stick to those goals. So, for example, if you're in if you're an international mutual fund, it would kind of go against the whole thesis of that international mutual fund if you were holding U.S. domestic companies of any size, but especially of a large variety. You're kind of going against the prospectus of why people would buy that international mutual fund.
Okay.
That makes sense?
Yeah.
So mutual funds, they let you pool your money with other investors to mutually buy stocks. That's why they're called mutual. Oh. You can buy stocks, bonds, other investments. They're run by professional money managers who decide which securities to buy, again, stocks, bonds, etc., and when to sell. An investor gets exposure to all the investments in the fund and any income they generate. And again, mutual funds are offered in a wide variety of investment strategies and styles, but you can't call it one thing and then do the other. I mean, I guess you could, but you're eventually going to get probably in trouble with the SEC.
Uh-oh.
All right, lastly, what's your definition of an exchange-traded fund, or ETF?
I don't even know what those things are. Okay. I mean, I was thinking they were electronically transferred funds. I mean, when I saw that, I was like, oh, okay, yeah. So I don't know.
All right, an exchange-traded fund is just like a mutual fund, is a pooled investment vehicle.
Okay.
It also holds a collection of assets like stocks, bonds, commodities, so on and so forth, and it trades on the stock exchange. One of the primary differences is an ETF will trade like an individual stock, so it trades throughout the day. So
you can do as many times as you want?
Well, that's one way to look at it. The other is when you trade throughout the day, you're seeing the up to the second or up to the minute price on it. Whereas a mutual fund, you can trade them, all day long too, but you're not the NAV, the sales price is not going to get set until market close. It's set once per day.
Oh.
Okay.
All right.
Now ETFs offer diversification, again, very similar to mutual funds.
Yeah, there's a lot of same words in these definitions.
Yes.
AI.
But they also, generally speaking, ETFs more often than not have a lower expense ratio. They're lower cost to hold. They're a little bit more flexible. And again, they allow you to trade in a single transaction, like you just said, throughout the day. Not that you would buy and sell the same ETF, but maybe you bought a bunch of different ETFs in one day. Whereas mutual funds trade only once daily.
Okay.
Make sense?
Right.
Okay. All right. So the general idea with holding a mutual fund or an ETF is to get baked in diversification, what that means is, in the worst case scenario, all of the individual stocks held inside either the ETF or the mutual fund should not all be losers at the same time, right? Law of averages.
Diversifying, yes.
Right. Now, on the flip side of that, what you give up in that is that it's unlikely that you'll have all winners at the same time as well, right?
Sure.
So in general, now again, this is in general, your best performing mutual fund or ETF will still trail the returns of your best individual stocks.
Well.
Right. So that said, we should reiterate, because we want to make sure that we're being fair with the, any type of conversation we're having here. We should reiterate that all investing involves risk, and having an all stock portfolio may not be the best idea for those of you in or near retirement. In full disclosure, at Gulf Coast Financial Advisors, we almost always hold a variety of ETFs in our portfolios alongside what is referred to as a stock sleeve, which is usually a collection of 8 to 12 individual stocks that we work together to pick, okay?
Okay.
The problem with holding all individual stocks is that depending on which stocks you hold, you will probably experience much more volatility in your portfolio versus holding ETFs or mutual funds, because what those ETFs and mutual funds, they tend to level out some of the ups and downs in your portfolio. So like we said earlier, generally speaking, your individual stock, especially if you're looking at growth stocks or tech stocks, they're going to have much more upside, but they potentially could have much more downside as well. Not that mutual funds and ETFs don't have upside and downside, but again, if you're in a well-diversified ETF, it's going to have that whole volatility thing is going to be a little bit muted. So let's get to the answer answer the question of whether you should hold individual stocks or not. Let's dig into this, okay?
Okay.
The biggest argument for holding individual stocks is that given the amount of newsworthy headline volatility, basically since COVID, honestly, and also during an environment where all of us are digesting the effects and the benefits of all this new revolutionary technology like advanced computing, robotics, artificial intelligence, all this stuff, we are witnessing historically high stock dispersion. What does that mean in English? It means that, especially since COVID, there has been a lot of stocks that have done really, really well, and there's also been a lot of stocks that have done really, really poorly. This has not been, for the most part, particularly 2024 and 2025, this has not been a broad-based rally. It's been a very top-heavy rally, i.e. the Mag 7 that we've talked about, Magnificent 7.
Yeah.
And what it does with the stock dispersion, it does create an environment where professional stock pickers might have an opportunity to produce stronger than average gains. Again, no guarantee on that, but it does present opportunities. Holding individual stocks, we're going into Nerdville now, Michelle. Yeah. They offer benefits like tax efficiency, which there is some baked-in tax efficiency with ETFs as well. But with stocks, you get to control it, the most control you're going to have in the investing world to realize when you have a gain or a loss. As I said earlier, they got potential for higher returns, generally speaking, than funds. There's direct ownership. If you own, right now Michelle owns 0.0000001% of Coca-Cola.
It's probably less than that actually.
But you have have a share vote.
I do. I get the notices all the time for all my stocks that I never vote on because I have no idea what they're talking about.
It also, like particularly
proxy
with preferred stocks, you have the opportunity for dividend income, which again you can generate out of mutual funds and ETFs. We're just talking about kind of cleaning out the middleman, if you will. But the flip side of that, it does require, and of course you can just throw your dart at a dartboard, and sometimes in a market that's screaming along, you just get lucky. Broken clock is right twice a day, right? Is that right, Michelle?
Yes.
But it does require significant research, and it carries higher risk if you're not properly diversified, unlike diversified funds. You gain control over what you own, how long you own it, and when to sell, which is a key strategy around tax loss harvesting. But you can do some of those things with ETFs. Another thing that you avoid to some degree on the individual stocks is you avoid ongoing fund fees. There are expense ratios and fund fees related to mutual funds and exchange-traded funds, okay? Where you're paying whatever management group is there.
Sure.
Generally speaking, historically, mutual funds have been a little more expensive than ETFs.
Okay.
And generally speaking, on the ETF side, historically, they were more involved in indexing and passive indexing, where mutual funds were considered a little bit more actively managed. However, I want to caveat that, and that whole world is changing. ETFs are becoming just as diversified, and a lot of savvy investors know that the capital inflow into ETFs started surpassing the capital inflow into mutual funds the last couple of years, and that's a sea change in our industry. There's still a lot more money held in mutual funds, but ETFs are gaining and gaining fast, okay? All right, so let's break it down a little bit here.
Why are mutual funds more expensive? Is that because you have mutual things, like you have to rally?
I think that's a fair way to put it. Historically, I think here's why. Mutual funds were put together as a way for a active manager or management group to go in and try to show how well they could perform in a particular segment of the market, right? Like we mentioned, international funds. If I'm somebody that has a lot of experience with international stocks, I may want to open a mutual fund, pick what I think are the best, 10, 20, 30, 40, 50 international stocks, and have that mutual fund and kind of spread the risk and reward out over that mutual fund. Well, in doing so, I'm going to have my hands in the kitchen a lot more versus ETFs.
Gotcha. Okay, so it's more laissez-faire. Yeah,
generally speaking, although, again, ETFs have come, especially in the last 5 years, 5 to 10 years, ETFs are the level of sophistication and options you have with ETFs is pretty impressive. But even so, you can take an actively managed ETF and pair it, look at and do a direct comparison to its closest kissing cousin on a mutual fund, and more often than not, you can purchase the ETF at a lower expense ratio.
All right.
And a lot of that's just baked in efficiency of it, okay?
Okay.
Again, the considerations of owning individual stocks, there's a higher risk due to lack of inherent diversification. sometimes you're just trying to get lucky. I don't mean to pick on any day traders or anything like that, but that happens. You also can sometimes fall into the meme stock trap that we've talked about in past episodes, where, yes, GameStop's shooting to the moon,
right?
But does GameStop have any
meme.
fundamentals underneath it to actually justify its shooting to the moon price? Not really, right?
Nope. Now,
this is part, we didn't do a whole lot of show prep on this, but I'm going to just give you our experience with the portfolios that we manage. We are relatively traditional in that we're going to, when we're doing all the new client discovery, we're gonna ask a bunch of questions. One of those is going to be around risk tolerance and time horizon. All right.
Okay.
So on the risk tolerance, just generally speaking, you're going to start on one side of the graph. You're going to be preservative, which means you're basically cash or cash equivalents. Then you're going to be conservative, which historically means you've got a handful more. You got a heavy exposure to bonds than you do necessarily what's called equities, which again are stocks and ETFs and mutual funds. Then you're moving into kind of the balanced world where you're kind of a 50-50 portfolio. Then you get to the moderate, then you get to the growth, and then you get to the aggressive, right? What we do, going to Nerdville here, Michelle, but a lot of times, more often than not, as long as it fits the client's risk tolerance and risk and time horizon, we're going to pair that kind of standardized risk tolerance, but we're going to make two key modifications, right? One, on the ETF holdings, we are not a huge we do hold bonds and bond funds in our portfolios, but if any of you are longtime listeners that have heard J.D. Gardner speak on the show or John Luke Tyner, they consider them kind of bonds of sophistication. I can't say that word. Can you say that word?
Sophistication?
No, when you steal something.
Larceny?
No, it's not that bad.
Confiscation?
Yes, thank you. Because with your bond performance, when you look at the interest, what's called the yield, which is a fancy way of saying the interest that is paid on that bond, if you just see that 4 or 5 or 6%, that can look attractive, but you've got to compare that to where inflation's at, and what you're really trying to figure out is your real return. And if you look over a longer time period, this is part that I think cannot be disputed. The upside potential and the capital appreciation of individual stocks, ETFs, and equity-based mutual funds is going to outperform bonds simply because it almost has to. I mean, if your stock market's not outperforming your fixed interest instruments, then we got a problem with the stock market, right? So we are going to try to, for somebody that would say be a traditional 60-40 portfolio holder, 60% equities, 40% bonds, we're going to walk through an educational exercise with that client to say, hey, let's look at more of a 70-30, possibly even maybe an 80-20, and how we're going to keep that portfolio risk neutral is we're going to look at doing a little bit of hedging on that portfolio so that when we have this volatility that kind of seems to be part of our weekly or monthly lives in the stock market, you have a plan for when the market is selling out. You're not just sitting there on your hands. You're actually generating a little bit of cash to hopefully purchase some things when people are trying to go for selling and looking for the door. You're hopefully purchasing at a long-term discount. There's no guarantee on that. But what you're trying to do is reduce your cost basis over time. And then the second thing we're going to do, as long as there's enough funds in the portfolio, and we've got a fairly low bar to chin on this, but we're going to add an individual stock sleeve. Again, because you never can guarantee that the stock that you pick, like one of my favorite stocks, I'm going to avoid trying to sound like I'm recommending individual stocks. And Michelle did not individually recommend Coca-Cola.
I did not.
Yeah, the
That's
drink.
just stating the facts.
Yeah, she recommended the drink, not the stock. Buyer beware. But
Yeah.
The point being is we're going to do some pretty heavy research on these baskets of stocks that we're mixing in there, because while you can do a great job on the fund side of the portfolio, the ETFs or the mutual funds, even if you do a great job, sometimes that you're doing just a little bit better than average. The stocks, if we do a good job picking the stocks, that's kind of our nitrous to our engine.
Okay.
It gives us hopefully a little boost. That's right. One of my favorite stocks has had a great run up until last year, and it's kind of sputtered along. But it's one that I truly believe in, and we've held with it for a long time, and it's starting to do its thing again. There's just a lot of research that goes into picking those individual stocks, but there is a specific reason for holding those individual stocks. You're trying to add a little nitrous oxide to your V8 engine. Does that right? All right. Any questions on that?
So many.
So many. All
go
right.
ahead.
Well, we got the rest of the episode to flesh this out. And then also, I think another potential downfall for putting too much emphasis on individual stocks we kind of touched on this earlier, but is the speed of investing information being spread across multiple platforms? And I hate to tell you all this, but a lot of it's just bad information.
Right.
I mean,
yeah, sure.
Not to pick on him specifically, I'm sure he's a nice guy in person, but Kramer, somebody did a tracking, and we talked about it many episodes ago, but they did a tracking on his individual stocks over the years. It was terrible.
Yeah.
It was terrible. So if you're watching him and you're picking what he does, you're better off maybe paying attention to what Nancy Pelosi does on her stock portfolio potentially. But you just got to be careful about the bad information. And we talked about this a couple episodes ago with Peyton, the fact that many stock trading apps, such as Robinhood, are set up almost like an online casino.
Yes.
Right. And what that does is that kind of encourages more gambling-like behavior versus true investing. Versus true investing type behavior, especially when you're trying to think out your stock allocations. But I'll give credit where credit is due. J.D. Gardner says that picking the right fund manager is important. Picking the right allocation is the whole ballgame. Does that make sense?
Yes.
Okay. And for listeners, what that means is, if you go into like a traditional 50-50, 60-40 type of portfolio, and you're putting, and your advisor is putting all the credence to the upside potential of that in the fund managers they pick, that should be at least a small red flag, because the fund managers, yes, there are really good fund managers out there, but again, with all of this technology, the playing field has tended to level out a little bit. That's why you've seen the dramatic rise of private equity. What you can do as a regular retail investor to kind of level the playing field a little bit is pay more attention to your allocation. Do you have the risk tolerance and the time horizon to stomach a little more exposure to individual stocks and equity-based ETFs and mutual funds? If you do, and you can play the long game, historically, what the market has proven is that is the most horsepower that you're going to get for compound interest and compound growth, right? Okay. All right. So that upside, having the stocks leaving your portfolio, again, assembled by professional money managers, the folks that we work with at Gulf Coast Financial Advisors.
Mine is not assembled by professionals. It's what I like.
It's just what you like.
It's a lot of fashion stuff or whatever.
Oh, gosh.
I mean, but that's a benefit from your sleeve, right? Like you get into the things that you want to do well.
And 100%. Yeah. I mean, again, we've said this before on the show. We're not here to slap people's hands. I mean, we're going to listen to your input, and then if you do have something that you would like us to look at, we have the deep research, and it's not just AI generated.
I've got some stinkers, but I believe in them, so I'm just hanging tight.
Well, the main thing, folks, is your allocation, and don't let the scare advertising and not to be a jerk, but sometimes the annuity guys, don't let them scare you from investing in quality companies, whether you do it through a package like an ETF or you do it individually. Now, of course, that's got to match your time horizon and your risk tolerance. But, for those of you all that have historically maybe steered away from that, simply because you didn't feel like you understood what you were getting into, that's a perfect time to give us a call, because that is one of the things that we definitely walk through. And we're not here to tell you what to do. We're just here to show you how we do things and make sure you're comfortable with it. And if you are, let's go. If you want to set up that follow-up conversation with us at Gulf Coast Financial Advisors, it's very easy. You can call 251-327-2124, or you can visit our website, gulfcoastfa.com. Gulf, like the Gulf of Mexico, Coast, FA is in financialadvisor.com. On the site, in the upper right-hand corner, there's a blue button. Click on that, and that's going to get to my calendar. On there, you got 3 choices to set up a meeting. It can be as simple as a 15-minute introductory phone call. It can be a 30-minute Zoom or Google Meet, or our preference is to meet in person at any of our 3 office locations. We have an office in downtown Fairhope in the Portico development. We have an office in Orange Beach. This is down the road from the wharf. And we have an office in Mobile. It is near the intersection of Dolphin Street and I-65. However you reach out to us, we would love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement. Then we give you our honest opinion about these headlines. So join us after the break to hear Michelle and I discuss this week's relevant headlines with our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host, Josh Null, here alongside co-host Michelle Lee Melton-Null. How you doing?
I'm all right.
All right. As we discussed before the break, every week we scour the internet for financial articles that pertain to those of you, the interwebs, for those of you that are in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. A couple notes. We try to pick headlines that are not clickbaity, that actually have real information and are not just, you drill down, you read for 5 minutes, and at the end of it, it's basically an advertisement for buying gold. And the second note is, if you want to read these referenced articles, and we highly recommend that, we include the hyperlinks to the articles in our show transcript, which you can find on our website, gulfcoastfa.com. Just go into the podcast tab, find the episode that you want to check out the referenced articles. And now, with all that and without further ado, here's Michelle with the headlines of the week.
Okay, for our first headline, we're looking at a provocative, ooh la la, piece called The BlackRock 2026 Investment Outlook. They are calling the current stock market a, quote, diversification mirage, unquote. The article argues that for years, investors have been told to just, quote, buy the index and chillax. But in 2026, with just a handful of AI and energy giants driving nearly 80% of the S&P 500's returns, holding an index fund means you aren't actually diversified. You're just heavily concentrated into 5 companies without realizing it. So, Josh, the article suggests that in 2026, passive investing is actually a passive risk. Is it time for retirees to ditch the ETFs and go back to owning individual blue chip stocks where they can actually see what they own?
Well, no, not necessarily. And I appreciate the article, but how they framed some of that was a little bit misleading, because it's not that difficult to find the holdings inside of an ETF. You can find the individual stocks there, right? So no, I get where they're going with this. Historically, the financial services industry, like you said, has told investors that picking individual stocks was just too risky, right? My argument for that is because I think a lot of financial advisors, and I don't mean to pick on my industry, but maybe I am, they just don't want to deal with the blowback if their stock choices perform poorly, right? As opposed to mutual funds or ETFs, which, again, generally speaking, tend to offer a little less upside, but also typically less downside risk. They just tend to, it's law of averages. You're spreading the risk and reward out over a bigger pool of investments. But if you look at the reality in 2026, if you own a normal or standard S&P 500 index fund, which most people have in some form or fashion, generally speaking, you are essentially, whether you realize it or not, and you have been, a tech speculator, because so much of that index fund's value is tied up in high-flying tech stocks such as NVIDIA and Apple. In fact, the top 5 stocks in the S&P 500 now represent a larger share of that index value than any point in the last 40 years. Did you know that?
Of course, I did not know that.
Right.
But I'm not surprised based on...
Yeah, based on how much we've talked about, especially the Mag 7.
The top 7, yeah.
Right. How much growth they especially with all the investment in AI. And right now, the stock market investors in general are rewarding these companies for their, what they call, if anybody wants to know what CapEx is, CapEx just means that it's capital expenditures. When a company makes a profit or has access to debt instruments like bonds or bank loans, they can choose to use that capital in a variety of ways. They can do stock buybacks, right? They can pay down other debt. They can hold the cash. But what has happened with these largest companies, the companies you can name off the top of your head for the most of y'all, NVIDIA, Apple, Amazon, Tesla to some degree, so on and so forth. What they've done is they've taken that cash flow and they've invested it, capital expenditures, and they've invested it heavily into AI technology, both in the models that they're all developing and also in the data centers, right? Now, when you own The index, when you own the index, like the S&P 500, that's easy. That's probably the most common index fund. You own the good, the bad, and the sometimes politically vulnerable. When you pick individual stocks, on the other hand, you do have veto power. I guess as an ETF holder, you could try to call up the managing company and convince them to get rid of stock A and buy stock B, but you're probably not going to get very far. But if you own the individual stock, you can just tell yourself, I don't want to own stock A anymore. I want to sell it and I want to buy stock B. And especially if you got a company that starts prioritizing things, maybe in this environment, maybe they prioritize politics over profits, or if their dividend growth stalls, you can fire them. I.e., you can sell that stock. You can't fire a company inside an ETF. I'm sure you can try, but I don't think you're going to get very far. The problem, sometimes firing. Like if Michelle fired Coca-Cola right now, it would probably involve a little bit of loss.
The Olympics are coming up.
There you go. It would potentially involve a huge loss. So you got to be aware of all that. There's a place for both. The point of the episode we wanted to do today was, one, not try to convince everybody listening that you need to own individual stocks, but try to make the case that at least have an open mind and learn and get a little more education, whether you do it through Gulf Coast Financial Advisors or this radio show or maybe yourself or another advisor. And two, that if you are looking for long-term compounded growth, having an equity-based ETF or mutual fund, and when I say equity-based, that means that it is holding individual stocks, shares of company inside their ETF or their mutual fund. As long as you got a long enough time horizon, that is without a doubt your way to hopefully have the most upside compound growth that you can find. There's no guarantee on that, but that's what you're shooting for when you go that direction. Very good. What's next?
All right. Okay. Our next headline takes us into the brave new world of 2026. A recent deep dive from InvestSuite claims that we have officially moved past the era of chatbots and entered the age of agentic AI?
Agentic AI.
Okay.
Very good.
The report says that AI in wealth management is no longer just summarizing meetings or answering basic questions. It has become a do-bot.
That's right.
D-O. Bot. Yes.
Yep.
These AI agents can now automatically execute complex workflows like real-time compliance checks, that's handy, and even initiating portfolio rebalancing without a human ever touching a mouse. The article even uses the phrase, intelligence is becoming too cheap to meter. Josh, if high-level financial intelligence is now essentially free and automated, what happens to the army of mutual fund managers, brokers, and ETF analysts? Is that right? Analysts.
Hey, look at me. I corrected you for fun.
Right. Analysts
Yeah.
who used to get paid for that expertise. Are we watching the professional extinction of the middleman?
Well, what you're hitting on is the great displacement, if you
Sure.
will. So for the last 30 years, fund managers and brokers have lived behind kind of a curtain of secret knowledge, if you will.
It's like Wizard of Oz.
And, the funny thing is, there's longtime listeners saying, well, you and I are part of who's been trying to pull back the curtain because,
Yeah.
I always wanted to have
Smoke and mirrors.
Well, sometimes, but I mean, a lot of it is just it's a way for someone to justify a higher fee if
Sure.
you don't understand what they're doing.
Yeah.
Right. I mean, think about auto repair. The more complicated and the more that they can confuse you with the explanation, the higher the bill it's going to be. Right. Now, they charge these fund managers and brokers. They charged a fee because they had the data and you didn't, and the data was harder to get. Well, that curtain is, for the most part, it is gone. In 2026, a AI bot can process 50,000 earnings transcripts in the time it takes a human manager to pour a cup of coffee. So the point of that is, this is where it lands. Because let's have some honest talk here. Back when robo-advising came out in 2013, 14-ish, with, good grief, I'll think of the name in a minute, but when the robo-advisors came out, our industry was a little spooked. We really were, because it was the first time they were using kind of computer math intelligence on picking stocks and ETFs, and they were doing it at a really, really, really low fee. Well, fast forward to 2026, and those companies are still around, those robo-advisors, but they have not done anything like they originally anticipated.
Okay.
In fact, even the biggest ones are still a fraction of the size of your large wirehouse and brokerages, right? Okay. And what they found, and also, too, the interesting thing, for any of y'all that have done some of those robo-advisors, you've probably seen your cost basis creep up over time because these super low fees that they were charging, they come to find out they could not run a profitable business over it. So they've creeped up, especially on the smaller account balances, they've creeped up on all of that. So what's all that mean? It means that if your advisor, so back to what I was saying, the financial advisor industry, there's definitely some alarms going off around AI, to be fair, right? But I think the biggest alarms are going to be if you just got a middleman kind of advisor who's picking a few mutual funds or stocks or whatever and emailing you once or twice a year. I'm telling you, Michelle and I talked on this on the last episode. Your broker is a dinosaur.
Yeah.
Yeah, maybe they don't realize it yet, but they are, if they're not obsolete, they're getting close. And I'm sorry for my brokers that are listening to this. AI can do what you're doing right now for $20 a month, right? But here's back to the problem, right? Kind of with the robo-advisors. AI can solve for the math, but it cannot solve for the emotion.
Right.
All right? When the market drops...
It's supposed to enhance, not replace.
Right. This is where comprehensive financial planning comes into place. When the market drops 15%, in a few days or a few weeks, like, we saw last October, the AI glitch last October, a computer is going to give you a logic-based chart. An advisor, a good comprehensive financial advisor, is going to talk you off the ledge so that you don't sell at the bottom and potentially ruin your retirement. In 2026, you should not be paying just for, quote unquote, stock picking. That is a commodity now. You should be paying for Michelle's favorite thing, behavioral coaching and strategy, because she says my behavior needs a lot of coaching. But if your broker isn't talking to you about your life, your legacy, your taxes, if the AI bot is not talking to you about your life, your legacy, your taxes, your estate planning, your risk management, you're paying human prices to that broker for robot-type service. Does that make sense?
Yes.
Now, you mentioned agentic AI. I believe that's J.P. Morgan Chase. Is that right? Is that what the article said? Yeah, is it? Yes, J.P. Morgan Chase. Agentic AI, like Michelle said, it's a do-bot, D-O-bot. It's designed to act. That is, it's not just giving you analysis. It's actually initiating trades. It's filing compliance reports. It's rebalancing portfolios automatically and autonomously. The benefit of that is it's already reduced a lot of the prep time or the efficiency gap, if you will, of a human advisor by probably 50% or more. But for the advisors like we are at Gulf Coast Financial Advisors, that actually presents an opportunity. Because longtime listeners know, Michelle knows this, I have zero interest in staring at 3 computer screens all day long.
Correct.
That is not where the really value, and looking at, oh my gosh, ABC is down 2 cents, I better do something about it, right? Our value is for the long term. How do we put together the GPS coordinates of your entire life to help you get where you're at right now to get where you want to be? And also, once you get where you want to be, for a lot of you would be retirement, maybe even early retirement.
Yes.
Once we get there, how do we make sure that those GPS coordinates are automatically updated and on an ongoing, continual basis through our financial planning process, so that when life's inevitable curveballs get thrown at you, your financial plan can handle it. You can handle it emotionally. You can handle it legally. You can handle it from a tax perspective. All these things that we all know people, and some of us experienced ourselves, where you get to come to tax filing, and if you've got a tax preparer versus a tax planner, they say, oh, hey, by the way, here's your 6-digit tax bill. And you're like, holy cow, what the heck? Where if you're ahead of this with comprehensive financial planning, incorporating tax planning, and the right CPA or accountant working alongside us, these are things that we're going to be working not only to address, but hopefully to reduce legally throughout the whole process, so you don't have these gigantic surprises. So, Very good point. Yeah, it's something, though, in my opinion, it presents an opportunity, not to oversimplify it, but you and I are old enough that when we went to college, we probably took, how to use the internet type college courses, or at least I did. I learned how to type on a typewriter. Did you?
We had keyboarding.
Okay. Well, we learned how to type
but it was running on DOS.
Back in the Ozarks, we learned on a typewriter. But the point being is, you get the laptop, which in one argument can say, well, you just eliminate all these reasons for typewriters and all this human input, and now, all those jobs are going to go away. But the laptop itself has opened up all kinds of new opportunities and way to do business. And that's just one simple example. Yeah. And I think that's where AI is going to go. The people that always want to give you the most dramatic projections or predictions around all this technology, and you know what I'm saying, listeners, like just rewind in your mind, .com was going to make it where we never shopped in a store before. The mortgage industry is going to make it where everybody could buy a house without a lot of risk. What's another one, Michelle? crypto is going to make it where we can, transfer money easily back and forth without a middleman. Still waiting on that. I mean, there's just a lot of things where everybody told you that the world was going to change overnight,
Flying
and
cars.
it does. Flying cars, yeah, it does. I mean, we're the world is changing, but generally speaking, it normally doesn't change just wholesale overnight. All right, we got time for one more.
Yeah, one more. This is from one of your favorite guys, Michael Kitces.
Michael Kitces, yes.
The blog is titled The Future of Financial Advice. This article argues that we are entering an era where artificial intelligence and new engagement tools are going to handle the heavy lifting of financial planning, everything from data gathering to building the actual models. The premise is that technology will become a commodity and the real value of an advisor will move away from picking stocks and toward the human experience in specialized niches. As I was reading through this vision of a tech-enabled future, it sounded a lot like double-edged sword. Is this technology actually going to give retirees better, more personal care, or is reshaping the service model just a fancy way for the industry to automate the human right out of the whole room while still charging a premium fee? Are we moving toward better advice or just more expensive version of a chatbot?
Well, if you let the lords of tech run completely rampant, that's what they want. And what you have in that experience is you have a very, very small group at the top making billions of dollars, and you have a lot of people that just want to make a good living or at least an honest living, not having the opportunity. So there's going to be at some point, the more that they try to push that out, the more at some point the society is going to push back. But specific to this conversation, we talked about this a lot on the previous episode, Your Broker is a Dinosaur. The article is right about one thing. The math of financial planning has become a commodity. There's so many great tools out there right now. We use a program called Right Capital. We love it. It's great. It's easy to use, but it's still, at the end of the day, it's a commodity. There's eMoney, there's Money Guide Pro, you name it on financial planning tools. Between AI and automated software, calculating a safe withdrawal rate or rebalancing a portfolio is more or less, it's free, practically free, right?
All right.
Yeah, it takes me, well, it used to take 10 years ago, it used to take me an hour. It takes me, 2 minutes now.
All right.
Right? Wall Street loves this trend because, like I was saying, it lets them scale. The problem is if they're scaling where they're just basically replacing human experience with the same cost or maybe even slightly less, but they're still charging a premium, you're missing the human element. What I mean by that, if you handle this right on one side of the equation, if you got an advisor that has got their advisor group that's got their finger on the pulse of all this technology and they're incorporating it, they're making the experience of helping you more efficient, not more distant, right?
All right.
And then on the other side of it, let's say that you are just convinced that you just want to have nothing but AI or robo-advisor or whatnot. You run the risk of what I call digital ghosting. And I can give an example of that.
Yeah, I need an example because I don't know what that is. I'm a Luddite, so I don't know.
This is a great example.
Okay.
So back when Blockbuster went online and had an app.
I did not know. I'm not aware of this.
Okay, Blockbuster had an app.
Okay.
And so I'm like, great, I can buy these movies that I love on Blockbuster, and I don't have to physically rent them. I don't have to purchase them. I can buy it, and I can just click a button. This was way back early in streaming, right?
Okay.
Well, guess what happened to Blockbuster?
They died.
And guess what happened to their app?
It also died.
And guess what happened to these movies that I, quote unquote, owned?
You didn't own them. They went away into the ether.
Gone.
Yeah.
Gone. Now, some of them transferred over in a strange way to Vudu or Fandango. No, Vudu became Fandango. The Blockbuster movies went away entirely.
Okay.
And I'm not telling you that if you've got a reputable company that's offering you AI advice, that's going to happen overnight. But these things are not permanent.
Okay.
Yeah, you're not going to be able to oh my gosh, my AI financial advisor.
If I've been digitally ghosted by anything.
Well, you're not. If your digital AI, your interface all of a sudden just goes black screen, you're not going to be able to drive down to downtown Fairhope and knock on the door and see what's going on like you can with a human advisor.
Stuff.
So, well, back to sum it up, the real value of an advisor isn't the software. That's just a tool in the toolbox. It's behavioral coaching. A computer can tell you that the market historically recovers from a 20% drop, but a computer can't sit across the table from you, look you in the eye, and talk you off the ledge when you're worried about your legacy or your investments. All right, and here's
or maybe even answer questions, because sometimes when I feel like I even try to experiment with the chat bots, they just latch on to a handful of the words and not all of them, and it just ends
Yeah,
up
they
being
run in
really
kind of a strange way,
frustrating.
right? And
Yeah.
they'll get better, but there's a way to incorporate that.
And then they're like, was this helpful? No, it was not actually. I just wasted 5 minutes with you. Ugh.
Oh, very good. All right, well, listeners, if you want to set up a follow-up conversation with the team at Gulf Coast Financial Advisors, it's very easy. Give us a call, 251-327-2124, or find us on our website, gulfcoastfa.com. FA is in financial advisor. On the site, click on the blue button in the upper right-hand corner. That'll put a meeting on my calendar. That could be a simple phone call, could be a Zoom, or our preference, it is an in-person meeting in any of our 3 office locations. Again, that's downtown Fairhope,
chatbot.
Orange Beach, no chatbot, Orange Beach, just down the road from the wharf, or in Mobile near the intersection of Dolphin Street and I-65. Please reach out to us. All right, coming up next, folks, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong? What I think is going to affect investors in the near future, maybe the distant future. We talk about all these things and poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Welcome back. Your host, Josh Null, here, joined by co-host Michelle Lee Melton-Null.
Howdy.
So I am opinionated, so is Michelle, listeners, in case you didn't know. I have strong opinions at times. I would say a radio show host that isn't opinionated would probably be very dull to listen to. And I am more pertinent. I'm paid in my profession to offer professional guidance and opinions to my clients. So if I don't have anything intelligent to say, just replace me with AI like we've been talking about. I do like making predictions, and sometimes I hit the bullseye, sometimes I swing and miss. So we're going to find out with Josh's crystal ball and big mouth if there's any crow for me to eat. Let's see what you got.
And there is.
Oh, there is? Okay.
Yeah,
I thought I was teed up pretty well on this one.
I think so. Okay.
The first one. I'm eating it badly. Ooh, rough.
Right.
This was rough.
You had a prediction that Alabama
Jay Stubbs. Yeah. I was trying to make him
going
feel
to
better.
beat Indiana in the college football playoff, which I am vehemently against just by spirit because I'm an Auburn Tiger and I don't like to entertain such things. So, but the Hoosiers actually beat the Tide badly. And then they eventually won the whole thing. Go
They did.
Hoosiers.
That's
and
right.
that's pretty neat for them.
Who would have thought? 2026, right?
So,
I was way off on that. Yeah, sorry,
so
Jay.
eat. Right. Crow, crow, crow.
I must have jinxed them.
Okay.
In the true Auburn spirit.
Yes. You say, well, jinxes don't.
I'm going to do reverse jinx.
Yeah. You say that jinxes don't exist.
Jinxes
but
don't exist.
I don't know, man.
Auburn fan, listen to me. There's no such thing as jinxes. Get over it. From a reformed Chiefs fan, jinxes don't exist.
I don't know. Okay.
All right.
Let's pivot to a prediction that actually affects investors. Early last year, you stated that investors should be wary of Tesla, at least when it came to being the dominant player in EVs. In 2025, Tesla fell behind Chinese EV maker BYD in overall sales volume and faces regulatory scrutiny over its full self-driving technology.
Yep.
Not to mention brand damage from CEO Weirdo Worms, various controversies. He's crazy. He has like 36 kids. But anyway, okay. There is also potential loss of vital revenue from regulatory carbon credit sales, and many analysts feel that CEO Elon Musk is betting the farm on AI and driverless taxis. We seen one in Atlanta.
That's right. Yeah. Waymo.
Waymo, and it makes like 36-point turns. It doesn't turn. Okay, anyway, but
it turns like a old, very, very old driver.
Right. But as you and I saw in Atlanta, there it was. A few weekends ago, we did see the Waygo, and it's 36-point turn. Waymo, sorry. It's already making miles ahead of Tesla in this tech, and literally because it's putting down mileage on
100%.
driverless cars. Despite all of this bad news, Tesla's stock price has remained surprisingly resilient. So, Josh, What's the future hold for Tesla, and why should investors give a rat's tail?
Well, here's why they should care. Tesla right now, as of this recording, is the 9th highest weighted stock in the S&P 500, around 2.25% of overall index value. What does that mean? That means that if Tesla were to take a real gigantic dive on the stock price, it's going to affect a lot of investors that are invested in index funds, particularly S&P 500 index funds. So that's why it matters to investors. It has been, whether the fundamentals were there or not, it has been one of the...
Do you think I can afford to put that in my stock sleeve?
I don't know about that. But it's because here's the thing. I mean, it is important to investors, but on the flip side of that, the stock has remained somewhat, I mean, it's down, but it's remained somewhat resilient. And I think primarily for now, it's because investors are buying Musk's story around artificial intelligence and driverless taxis. But I'm going to tell you all right now, if you pay attention to global events, Tesla, the car manufacturing part of it, is in trouble. I mean, BYD, you kind of soft-sold it a little bit. BYD is kicking Tesla's butt so bad globally, and that's without having sales in the United States. BYD can't sell in the United States.
And the population's going low in China.
But Tesla can sell in China. And even with that, BYD is beating Tesla so badly that a lot of even European companies are trying to figure out a way to slow down BYD and the other Chinese EV manufacturers. So we've talked about this before on our episode. I know that there is a historical push, historical. The last handful of years, there definitely was a push back against EV because a lot of people felt that the government overreached with the pushing people towards EVs and the restrictions around emissions and all that. And there's an argument to be made to that. We've made the point on this is that you got to be somewhat careful there. And Michelle and I both drive, internal combustion engines. We both drive, right?
Yeah.
So we're not trying to, be holier than thou or anything like that. What I'm trying to tell you is you got to be careful with that overall conversation because when you're ignoring what is happening in the rest of the world, and the rest of the world right now, we Ford, Chevy, Tesla, all that, they've got a real fight on their hands to continue to be the dominant automotive manufacturing presence in the world, primarily because we kind of took our eye off the ball and we let China's EV manufacturing gain so much ground. And Tesla matters, whether anybody agrees with them or not. Tesla, the company, matters to investors and it matters to the U.S. economy. So there you go. Very good. Well, listeners, I hope you enjoyed a little peek in how we form our opinions and make predictions. We invite you one last time, if you'd like to have a no pressure, no obligation conversation about your investing goals and retirement dreams, give us a call, 251-327-2124. Or again, find us on the website, gulfcoastfa.com. Right-hand corner, there's a blue button. That'll put something on my calendar. My preference, don't mind talking on the phone, don't mind doing a Zoom, but I prefer meeting in person. Why don't you set something up with us at our downtown Fairhope office, or for you beach people, somewhere set something up at the Orange Beach office, or for you Mobilians, go Mobile.
Townies.
That's right. Find us at near Dolphin Street and I-65. That is our show for the week. I want to give a huge thank you to my returning co-host, Michelle. Hi, yay, good job. The regular listeners are cheering. We can hear you.
Yes.
Thank you to the producer of the show. That is my son, Peyton Null. Thank you to our show sponsor, that is Providence Partners and Mr. Jay Stubbs. Thank you to our awesome radio station, that is FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, that's local band Sloth Racer. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Null and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.